So thank you very much for tuning in to the Compassionate Capitalist podcast and video today. Of course, I'm Karen Rands, and my guest today is Tiffany Wright. And I am really excited about this topic. I'm really excited about Tiffany being my guest, and I'll tell you why in just a second. But the topic itself, you know, as much as I have advised entrepreneurs about different sources of capital, as much as there's webinars and books, and in fact, Tiffany is the author of a best-selling book about access to capital and types of capital that's out there that we'll talk about here. It's always amazing to me how little knowledge there actually is out there, how many people, business owners, startups, growing companies that are expanding and maybe thinking about acquiring something else, and even people that, you know, in this day and age where people may take early retirement and they're not done and they want to either start or buy a business, they just really don't have any idea all the different types of capital that's out there. So we're going to cover that, the basics, the nuts and bolts, and then some best practices to make sure you as an entrepreneur are doing what you need to do to get capital. And if you're an investor listening, you need to understand this, because every company that gets at any size will have a combination of debt and equity. And so financing. And so it's important for you, even as investors, to understand where the other sources of capital are, how your company that you've invested in is going to qualify for it, so that you can mitigate your risk, reduce your risk, because, you know, nobody buys a house with 100% cash, right? They always use a combination of their cash and the bank's cash, right? Because that's an affordable, cheap capital to be able to finance a home or other types of investments. So let me introduce you to Tiffany. She is and I didn't know this about her, but she's got an engineering background from Ohio State. And I knew she had her MBA from Wharton School, from University of Pennsylvania. She has her company now. It's called the Resourceful CEO. And she helps small to medium business-to-business companies restructure their operations and financing to generate high revenue, stronger cash flow, and greater profits. Doesn't that sound awesome? Her clients have experienced revenue increases of 10 to 40%, profitability increases of 20 to 250%. Hello, everybody. And doubling to quadrupling your cash flow in under a year. Tiffany Wright will talk to us about all of this, and I'm going to give her some questions, and she's going to answer them. And then, of course, you can always go to her website, which is it's the resourcefulceo.com, theresourcefulceo.com. And she's got resources and information that's out there. And of course, she's also, the book I mentioned is called The Funding is Out There, Access the Cash You Need to Impact Your Business. There she is. You're watching the video. She's holding it up. And you can get it on Amazon and on order at bookstores and all that kind of stuff. And whether you've got $300,000 transportation business, or a 20 million business services, or just an aspiring entrepreneur, you need to know the types of capital that's available to you at those different stages and different industries and all that kind of stuff. Okay, so let me give you some personal stuff about Tiffany. Then I'm going to let her come on. I'm going to ask her a question and let her come on. So we first met back when she was a business advisor at Georgia Tech. And I was working with them. They had a organization that was part of it through the Minority Business Development Center, had an office there, and was working with trying to grow manufacturing companies, minority-owned manufacturing companies, traditional types of companies in Georgia, and grow them. And she was a business advisor working on that. And she probably doesn't know this, but at the time I was, working with startups and things, and I was running the angel investor group here in Atlanta. And I always just called everything private equity. And because it was a private company and investors are getting equity in it, so there were private equity investors. And she said to me one time, well, private equity funds don't do business with startups. It's private equity as an industry is not angel investing. And I was like, what? And I was like, I was just, it was one of those things now, what is it, 16 years later? Something like that.
Mm-hmm.
It's like, I'm like, I still remember that aha moment that Tiffany enlightened me with. And I had to caveat it because at the time I was coming up with the Southeast Private Equity Conference, and it was angel investors and VCs, not private equity funds. And I was like, well, I'm still calling it SPEC and it's still the private equity conference, but I had to always add that in it that, and now that I work with companies that are in that gap of they've already had their angel round, they missed the VC round, they're too small for private equity funds, right? And they're trying, how do they get their money? How do they grow past 3 million, 4 million to 10, 20 million? Then, it's just part of my vocabulary and I always clarify it now, but she was the one. So thank you very much, Tiffany, and welcome to the Compassionate Capitalist Podcast. How you doing?
Thank you for having me, Karen. I didn't know that.
Yeah, I know. That was my little golden nugget, my little Easter egg I was going to give you there. So, okay. So, tell us the journey. You were an engineer, background. Did you go into, what was your journey to coming through that, to go into getting your MBA and then becoming an entrepreneur advisor at Georgia Tech and now the Resourceful CEO? Connect the dots for us.
Okay. Okay. I was an engineer at Ohio State. I remember I changed from mechanical to industrial, and it was funny. I had a teacher in high school that said I was better suited to industrial, and I said, no, I've chosen mechanical. But he was right. I was bored in mechanical engineering classes. I actually fell asleep. But industrial, I loved. How to take things and make them better, how to work, how to look at the whole scope of a process or machines or whatever and figure out how to make them work, how to make the people who are using them operate best within that. So anyways, then I went to work for Honda, and I went to work for Honda, spent 2.5 years in the US and 2.5 years in Japan. When I was in Japan, I traveled around Asia and I just saw the world of possibilities. And then that's when I said, I need to be an entrepreneur. Before then, I never considered it. It was just get a job and climb the ladder, but I never felt passionate about it. I just, like, that's what you do. And so I said, well, I also liked finance. I spent a lot of time doing my own personal investing and reading and finance books and so on. So I said, I think it's time to get an MBA. My father, when I was in high school, my father had said, you should get your engineering degree and then an MBA and then a law degree. And I was like, I don't know about the law degree, but I'll consider the MBA and when I'm ready. And so, sorry about that. So I decided, I knew I wanted to be able to go around the world. So I wanted an MBA degree that would I wanted an MBA from a school that had cachet around the world. So I opted for Wharton and obviously the finance piece. So I went there. And my goal was I got an excellent education, but my goal afterwards was to round out my experience so that I could eventually buy a company. And so that's what I did. I went to work for Enron afterwards. And when I was at Enron, I did work in we had to rotate through different groups. And I worked in one little group little being that there weren't that many of us in the group, that funded small businesses to the tune of $5 to $10 million. And so that was my first experience working with small businesses. And I would talk to them and I'm thinking, I'm not a marketing person, but yet I'm understanding more about what you need to do to build a stronger business than you do. And so I realized that a lot of entrepreneurs or a lot of business owners go into the business because they recognize they have an idea or they see there's a gap or something like that, but they may not understand all the fundamentals of running the business. And so that's the help that we provided to make sure that they were strong enough to return our funds to us with a nice return. They had to invest in suitable companies and get our money back, right?
Yeah.
So then I decided to go to Siebel Systems. So I left Enron about a year and a half before the meltdown.
I was going to ask if you were there during that, how crazy would that have been? But you probably still had friends there at the time. So that's for another show. But.
Yes. So no, I left and I went to Siebel, and I thought, okay, Siebel is great. I learned how to build partnerships. They were really focused on partnerships as a way to grow. And so they had this structure that was basically imprinted upon me. Obviously, I worked in it, but and I grew the energy vertical. That's where I was coming from, energy. And it was a really good experience. And then I got a little bored, which is I tend to do. I get bored after a couple of years. I moved to a different area, and then Siebel had a mass layoff, and I was caught because I was in a new department, and I hadn't contributed anything, so of course I was expendable. But it was
first in, last in, first out.
Yes. That's right, LIFO. The biggest thing was that I was going to use my options and use it to buy a company, because I figured I needed about a good million and a half of my own equity to buy a company. And my options were decimated because that was the whole tech meltdown, 2002.
Sure.
Yeah, I left Siebel in July. I had a leave of absence, but so it was officially November of 2002. And anyways, so I said, I looked at franchises, looked at other things, and I decided to pursue real estate investing all out. And that's what brought me to Atlanta. And then I knew that I could sense the market was changing. I'm fast forwarding here. I sensed the market was changing. And so I got out of, I began to sell off my assets, because that was like 2005. I was in the fix and flip market. I had a bunch of apartments in Texas, but in Atlanta, I was in the fix and flip houses. And I had to line up all these hard money lenders and relationships with banks and so on. And so I guess I come honest to the different ways of getting financing. For instance, at Enron, I helped finance a barge-mounted power plant using MARAD, Maritime Administration funding, and Bank Boston, which is now, they've been acquired by probably 2 other entities since then. But so I don't even know who they're under now. But anyways, you get the point. The point is that resourceful or different ways of getting financing. There's always a way to obtain financing. Sure. You just have to think creatively, or there's always just different sources. So anyways, then I said, okay, so what do I want to do? Before I buy a business, I need to understand the psyche of the small business owner. And so I went to work for Georgia Tech. I actually cold called them. I cold called 5 different entities, and Georgia Tech was one of them.
Really?
And so I went there. And then, so let me just fast forward, left them, bought a small publishing company in commercial construction. And that one I bought that in 2008. And it was, the market in construction went down with the real estate. So my revenues went down, but I was able to shift it back up, but my whole customer base shifted. And so it was good. I mean, it was good while it worked, but then I got bored because I wasn't able to grow it like I wanted to because of the constraints, in the actual commercial market. So then I just decided to shut it down. And then I became an interim COO and CFO. First CFO, then COO, and I almost bought 2 other companies. And financing, no problem. For me, it was understanding the psyche of the business owner, because the first one, she just dragged her feet, and that was good because the aerospace industry went down, so that actually worked out. But in both cases, we had purchase agreements ready to be signed, ready to close, all the financing lined up. No problem. It was just the owners were waffling. Like the one gentleman was funny. The one commercial construction company we were going to buy, which is actually thriving during that time, and he just found out that he's actually selling his business now. So that tells you I was buying it, what, 12 years ago or no?
Wow.
10 years ago. 10 years ago. And he was in his early to mid 50s, but he had a 4-year-old. And so now he's really ready. Yeah. So anyway, so then I decided stop doing the interim and be a consultant. And so then that way I would just travel instead of having to move around all the time.
Yeah.
And so, yeah. And this year I will now, my goal this year is to buy one more business, is to buy a business by the end of the year. So that's the journey of the Resourceful CEO. Once I switched to consulting, I build myself as a resourceful CEO, and those results that you've been talking about, that's come through my consulting.
Yeah, so what's really interesting about hearing your journey is taking things, when you said that's why you went into industrial engineer, taking things and understanding the processes and making them better. And that's exactly what you're doing as a consultant,
yes.
Because you're analyzing their operations and helping them figure out where to get more cash flow, where to, improve their positioning so they can be in a position to get growth capital or to acquire another company. And having been through acquisitions, successes and failures with companies, all of that, I mean, it really is a perfect primer to be the expert that you are right now. So, I always my journey was also very ziggy zaggy along the way through my corporate gigs and, my own private, entrepreneurial and advisory things. So, I think that's folks that have been out there doing it for 20 something years are the best.
Yes.
Okay. So let's get into sort of the nuts and bolts so we can get a foundation, because I want to get into, because I want to lead our listeners into understanding, assuming that you have gone through this sort of startup. So understanding some of the places that people don't really think that there's sources of capital.
Mm-hmm.
Particularly, you've used a couple of examples. Enron that was making the investments. I know in your book you have case studies where people have gotten corporate finance. I remember early on when I was, it was an MIT forum broadcast, and this was again one of those golden nuggets. And this company had gotten to market. It was a brand new type of copier that, now we take this stuff for granted. But back then, I think it was either 3M or somebody had basically given them a lot of kind of R&D money to get it to the marketplace. And these are places that, people think angel investors, VCs, or they think a bank and a line of credit or an SBA. And those were all your traditional ones.
Right.
Or they have negative connotations of how you use receivable financing, or they have, there's all these paradigms. So let's kind of just go into the basics so people can get a foundation, and then we're going to razzle and dazzle them with things that they never thought of before, right?
Okay. What I always say is think about what you need the money for. What do you need the money for? Because obviously, if you're a startup, I'm a big fan of the bootstrap as much as possible, because then you can retain more equity and more leverage. So the more, like if you guys saw what was that movie about Facebook? Not really officially about Facebook, but we all knew it was. But if you have, if you come in from a position of power, you have a better negotiating position, and you don't have to give up so much equity. It's kind of like at Shark, you watch Shark Tank, and you see how some of the people say, no, I'm not willing to give up 40% for that amount of money or something like that. And so they'll wait and build their business more. But anyways, the point is to focus on what you need the money for. If you as a startup, you may need it for so many different things as a technology startup or something. But if you are a more traditional startup, you may need it for marketing, or you may need it for product development, or you may need it to get a like a COO or CFO type or something on onto your company's
Team.
roster. So so think of if you can break it down into the components that you need the money for, then you can get creative. Well, maybe for this COO, you can give them less money up front and give them either profit sharing or options, restricted stock, or something like that. For the marketing, maybe you can find someone who will do a co-marketing um, deal with you. For instance, I had a client who once went after they were a tutoring software company, tutoring software provider, and it was they were first trying to go after the parents and then go after one school one by one, but they connected with a large textbook entity, and that textbook entity provided them with a $3 million zero interest loan. And what the textbook entity did, to kind of differentiate itself from its competitors, it would sell the tutoring as an add-on to their textbooks, to the textbooks that they were offering. So it made their offering of textbooks that much stronger. So it obviously helped my company. My client got not my company, but my client got a $3 million zero interest loan from a strategic partner that also helped them to sell into the schools that they were going after. So it was a double win there. That's what I mean. If you think creatively about what it is you need, then you can hone in on the different pieces of that.
Right. And part of that is kind of mapping out your roadmap. I always say, when I help companies develop their capital strategy, it's to align with the business strategy and the growth strategy to figure out at what point do you bring in different types of capital. And to your point on bootstrapping, I've done podcasts and webinars on this topic. I'm sure you've done them as well. Things that people don't necessarily always consider, and they'll danger. So good, positive, good bootstrapping, right, would be some of the examples that you just gave. But also, like, I work with an organization that they offer discounted advertising because they are also a bartering organization. And so they have bartered with, TV stations and magazines and all this kind of stuff. And they have this whole exchange going on. So they basically monetize some of the credits they have with these entities that you would do traditional advertising, billboards, whatever, right? And so a product, whether it's a services product or, sometimes then you can get some credit towards advertising by offering up, to provide a discounted or a barter of your product is another way of doing that. And then there's also with sometimes, you can, I barter with people that might do like a web design in exchange for, some consulting or things like that. All those kind of things that people do. One of the risks is that sometimes people think, I'll do credit card, or they'll get a debt, or they'll get debt. And the problem is that when you burden your business with debt before you have adequate revenues, then you start to really not be able to invest in your own business and growth because you're burdened with this debt. And one of the things that I think is a debt that a lot of times becomes a slippery slope for people that they don't really get is when they go for cash flow lending, right? And they take a percentage of their cash flow out of their cash register when they're right. And then they're automatically have reduced their profits, and they're stuck. And it's usually pretty expensive money for like 12 months or 18 months. And they got this chunk that's always going out to this cash flow lender. And it can be useful if you have a very short-term need and you have something that's no penalty for paying it off early.
Yeah, well, that's the other piece. Cash management is critical. And if you're a startup and you have very little cash coming in from the sale of products or services, otherwise known as operational cash, then you're going to need financing cash because you need the cash to run your business. But what I do with all my clients, and I advocate everyone does, is a 12-week projection of your cash. So if you can see, and I think private equity firms use, or investment banking firms use 13 weeks for publicly traded companies and so on. But and larger entities. But I use 12 weeks, and that's basically 3 months. And you can see what's going on week to week and what's happening. And so it shows how your operations are, what's happening with your operations, but it also shows the impact of your financing, because this is cash. What people don't understand is that with financing, you have to pay back the principal too, but your principal doesn't flow through your income statement. So you're just looking at your profits saying, oh, okay, I have enough profits to cover my to cover everything, but you're forgetting that big chunky principal payments that you have to make. And so when you factor those in, you may not have enough cash. And so then you're at a deficit all the time. The other thing is you have to match the timing. If you have short-term needs, you get short-term financing. Long-term needs, you get long-term financing. Mid-term needs, you get mid-term financing. So if you are using a credit card to buy equipment, that's not good. No, 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 no. You should be using a credit card to buy something that's under 12 months, preferably. Actually, for a credit card, I would say that's, a few months. And line of credit, same thing. It's working capital. So it's inventory, or to finance the gap in your receivables if your customers are paying you in 30 days, but you've got to pay your people in 15 days.
Right.
Then, that's what you use it for. But if you're trying to open up a new location somewhere, you don't use your line of credit for that. That's not a short-term need. That location is going to be there. So you have to match. Otherwise, you are putting yourself in a precarious cash position.
Mm-hmm.
So when I talk about funding, that's really critical. And like Karen said, bartering it's a way of conserving your cash, and it is a GAAP, generally accepted accounting principle, recognized way of doing business. So if I provide you with the service, then I book that barter, that piece of the barter as revenue. And then when I then take the service from you or receive the service from you, I book that as an expense.
Okay.
So yes, it needs to be included in your financial statements, but it's definitely legitimate.
Great. And one of the things I also find, and let's kind of talk about, I think it fits into the this understanding your cash needs. So one thing I know, when I was at IBM, it was interesting in that they would reduce, like say sometimes equipment financing, like when they do floor plan financing, that's one of the things where when you have inventory that is on a showroom floor, cars or computers or this kind of stuff, anything that's hard assets, they'll do like a floor planning, which is financing the stuff that's on the floor, right? And then you have, but they would offer up like a reduction of 0.5% if you paid in 25 days rather than 30 days. And so you can go to your lender and negotiate sometimes some of those types of terms if you're revolving your inventory financing, things like that on a regular basis. But then one thing that people don't often understand when they get into manufacturing is how do you get purchase order financing? So you got to have cash on hand, usually, just like with a house. I don't know whether, I think going rates is like 20 to 30% of whatever your baseline manufacturing is going to be. So if it costs $1, if you're going to sell for $1, it's going to cost you 50 cents to make it. You got to have 25 cents or 20 cents cash on hand, and then they finance the rest through purchase order financing, which then gets paid off when it ships by the receivable. And then you got 30 days to pay that. But if you're bringing something in from outside the country, let's say, and you don't get it here for 30 days, it doesn't get on the shelf, you may have to float that for a lot longer than 25 or 30 days. And then you get into a bind where you're kind of, and I had this company that they wanted to do that kind of financing. And I said, understand that as you grow, it's going to take you 18 months to get out from underneath that burden of the receivable financing, unless you can to get to the point that you don't need purchase order financing. You got enough cash on hand to do it that yourself. And so it can become a very slippery slope if you don't do the analysis that I'm sure you do with your companies when you advise them.
Well, here's the thing. There's some really good purchase order financing entities out there. It's not as ubiquitous as some people think. There's not a whole lot of people that offer it, or a whole lot of entities that offer it, but there are ones that do offer it. There are actually some banks that partner with these companies that offer it. So I would definitely recommend the ones that the purchase order financing entities that have partnerships or relationships with banks that they can point to, because the goal is to get you to the line of credit, or to get you to the to like a trade, what do you call it, a letter of credit or something like that through the bank, as opposed to, which would be cheaper than using the purchase order financing. But a good purchase order financing, if it's 60 or 90 days, then they will cover the whole thing. So they would need to know how long it takes it to be manufactured, and how long it takes it to be delivered, and when would you be receiving payment from the customer. And assuming that that customer pays very well according to the contract, and does not, if it says the customer is paying within 30 days, then the customer does pay within 30 days. It does not have a history of paying in 45 or 60 days with, so basically what's the credit rating on that particular customer, with especially with their supplier. So they'll check that out. And then, so then the purchase order financing would cover that 90 days. So that's what you need to look for. If you're only getting the ones that are making you pay as soon as it is delivered to the customer, you need to find another purchase order financing entity, because that's not a good fit for you if you've got to wait another 30 to 60 days to get paid.
That kind of leads into the thing that I made a note I wanted to make sure we covered, is don't wait till you're desperate for your money, because what I just described, that's when this guy was desperate for his money, and that was kind of what he was doing. When we did that was like the trade credit thing. It took a little bit longer to put it together, but it was, a much cleaner deal. And that particular, the other company was their client was Walmart, which is notoriously for paying late. And unfortunately, this goes into your contracts. Sometimes when entrepreneurs are so glad they finally got the big guy that bought the thing, and they don't hold their ground. And so the return provision was very lenient for the purchaser, the retailer that was buying it. So they took returns from customers, and customers would bring the product back. And then when he basically went out of business, because he didn't have a tight thing that didn't allow for returns unless there was a defect, right? And so you've got to really look through your contracts when you're getting financing, or your retail contracts, so it doesn't put you in a bind that ultimately can put you out of business, because then you don't have a sales to pay your debt.
Right. Well, that actually is all operations, because it's not just defects. I mean, there can be other things that are wrong with your product that isn't actually a defect, but it doesn't meet the customer needs, and that's an operational issue. What's going on? Are you talking to your customers and finding out what the issues are? And if you're not, then you can't correct them. So it wasn't just the contract, although that was big. That sounds like he never really drilled down into why the customers were returning them and what he could do. He was just focused on, it's being returned and it's messing up my money. It's not just, again, funding is a means to an end. It's the operations of the company that really drives it. With smaller businesses, you rarely see a company going out of business because the funding, the financing was egregious. Well, that's not necessarily true when it comes to factoring and things like that. But it's usually the operations are a mess, and then the financing is also a mess too. But the operations are a mess, which then just exacerbates any financing issues that are out there. So yes, read the contract and stand your ground. But you also, if you're going to work with a very large entity that basically, because what they had was customer risk. if you have, and I always say you should never have more than 20% with one customer, ever. And you need to decrease that. But if you get a really good, you're starting out and you get this really excellent deal. I mean, you get this really, not excellent deal, but this excellent contract. So obviously you don't want to forego it, but now it's 40% or 50% of your business. You need to serve that customer, but you need to immediately focus on getting additional customers to reduce that customer risk. You must reduce the customer risk because that's what happened. I've seen it happen over and over and over again. I had a friend, an acquaintance of mine, purchased a building supply company. It was a $23 million purchase. And they lost a customer that provided 35% of their revenue. And so the private equity firm and the bank ended up taking over the company that they bought. So because they lost their biggest customer. So it's inherent at any level. And so that's one big thing that you really do need to take a look at. But then also, if you're desperate, you can't think. That's why I said do a 12-week cash flow, because then you can see, oh my gosh, in week 10, I'm really, really short on money. And then you can think about what you can do to cover that in week 10. But if it's next week or this week, you don't have that many options because some of these things take time. And if you want money quickly and you're desperate, you're going to pay really, really high interest rates. I mean, I'm talking, you could be, because if you're factoring, and I've heard people who are desperate getting factoring rates as high as 5%. That's 5% a month. That's 5% for 30 days, which is 60% for the year. How can you make any money? You can't make any money if your net profit margin is, let's say, 8%. You're
operating on 3%. You're operating, right? That's like you kind of run your business.
That's 60% of the sales price.
Well, but you're rotating it. You're paying the 5%.
No, I've seen people who have been factoring their entire 100% of what they sell. If you factor 100% of what you sell, then you're only and before you started factoring, you were only making 8%. You're now at minus 32%. And that's when I do the financials, that's exactly what it would be, minus 32%. But in their head, they're going, when you put it on paper, no, they have a loss of almost 33%. So no, don't wait until you're desperate. Think about it. Factoring can work very well. Like in transportation, you can actually get factoring that's really, really low. I mean, the rates are really, really low. There's entities out there that know how to lay off the risk in transportation. The key is to not factor all of your, not to factor everything, just to factor new accounts or maybe some slow paying accounts. Like the bigger entities sometimes try to pay slow. There's this big push on Wall Street for large companies to conserve their cash. For instance, several years ago, Lowe's got beat up because they paid their suppliers in 30 days, and all these analysts are saying you need to be like Home Depot and pay your suppliers and vendors in 60 days. Well, they're talking about small companies, small and medium companies. And how are those companies floating their cash? So they're basically floating these big companies. But anyways, the point is to focus on what you need and when you need it, and match your needs with that. So factoring can work. Like if you got a brand new customer and you need to jump up really quickly, and your bank line of credit says, we need historicals for 2 months before we increase your line of credit, or whatever, something like that. So you can use that for that new customer for that maybe up to 3 months or something like that, 4 months, or
So as a,
Like that,
almost
or you
like,
can use it, right, or you can use it
almost
periodically for
like,
something, but
yeah,
not all the time.
almost like bridge financing to a
Yes,
traditional type of loan, an SBA
yes,
loan. And there's all different kinds of those out there. And,
yes.
you know, we won't go into that. We don't have time for that right now. But
Right.
one thing that I think that there's a lot of confusion on, so I just want to cover one more piece of
Okay.
types of debt. And then I'm going to jump into some of the bootstrapping go back into the equity side.
Okay.
Talk about mezzanine financing and
Mhm.
where that fits. Sometimes I hear confusion in the marketplace. It's used as, you know, most often it's kind of like, well, when you're doing an acquisition, but it's also used in other places. And so sort of explain, because you'll meet people that go, oh, we're a mezzanine financing company. Well, where
Yes.
does that fit? So address
Yes. It's the primary place that mezzanine outside of real estate, the primary place that mezzanine financing plays is like you said, in acquisitions or in rapid growth. So it's because what the typical mezzanine financing firm does is they provide debt but with warrants. So they have the option to convert that debt into equity if certain conditions are triggered. Or it could be, I mean, and that's, you can negotiate that because it could be only if certain conditions are triggered, or it could be at a particular time, it's automatically triggered. So it just, again, there's room for negotiation. Just understand that you can negotiate anything, but just have an idea of what you want going in, because obviously otherwise you're kind of swinging in the wind. But so I, so let's, for an example, the one acquisition that didn't go through, we were using that was back when, you know, more debt was provided, but we had a lot of EBITDA, and so I won't use the term. So the bank was going to finance a lot of it based on the cash flow, something that was called an airball, but that's for another discussion. It's basic, meaning that airball meant that there weren't a lot of assets tied to that, but there was, the company had been in business for a while and it had reviewed financials, and it also had to put each month it provided updated statements to the bank. So the mezzanine finance, the lender felt very comfortable with financing so much of the deal. So then we needed another piece, and I didn't want to give away the equity, so much equity. So we had a mezzanine financing fund that was going to provide 2.5 million, which was, I think the minimum was 2 million. Originally we thought about 4 million, but the bank came up, so we didn't need as much, as because obviously the bank was the lowest cost of capital. But yes, so and what they were doing was they were providing 2.5 million at a higher interest rate than the bank, but with warrants, with the option to convert at the end of year 2, if certain things weren't, if certain things hadn't
Sure.
occurred. So I think we were going to have a partial balloon payment. Otherwise, it would convert to the warrants would be triggered. But anyways, so that's essentially what mezzanine financing is for. Or the other thing that it's for is if you are trying to put together a larger deal. For instance, if you are waiting on venture capital or some other large source of funding to come in that may take, because some of these things can take like a year, and it was not typical venture capital, but some kind of deals with PPMs and so on may take a year or so to put together. Well, bridge funding can be short-term funding, typically a year to maybe as much as 2 years, that that will um, that will provide you with an interest only, and then it's as soon as and then it's taken out by another source of funding.
Yeah.
And if it's not taken out, then they get significant equity in the deal if it's not taken out at the prescribed time.
Right. So now, how do people find those kinds of, you know, gap financing kinds of things, that bridge financing, mezzanine? In your book, do you reference them? Do you have links in
I
your
do. I
resources
do in the
that
back.
tell me how to get to them?
Yes, in the back, I have a list of resources, and I do list some of the mezzanine financing firms and where you can find them. I think what I did, there was this, I went to Wharton, so so it was a little easier for me because I just went into the Wharton database and was searching for mezzanine financing firms.
Yeah.
And
So
that's why I found some. But then also, my bank had recommended one. So, but there are, again, like I said, I provide resources at the back of the book, but there are some entities or associations that can provide you with lists. And this is what I say. People are always talking about, oh, I don't have a relationship. I don't have a relationship. Sometimes it's okay to code call. What you do is like what I did was when I was looking for private equity, when I thought I might need private equity for deals that I hadn't yet done, but just I was looking at and wanted to line folks up in advance. And it was myself and another Wharton grad. And so honestly, I reached out to 30 different private equity firms because I had this list and had gone through to see who funded my deal size and the types of deals that I was looking at. And then in the headline, I put 2 Wharton grads seeking funding for
oh,
B2B purchases.
there you go.
Yes.
That's
And
I
then,
just dropped the name there.
yes. And then all, out of the 30, I think it was 31 that I reached out to, 30 responded.
Really,
And
that's
even if
good.
and I looked in a Wharton database, I'm not in a Wharton database, but I looked at I went to all the websites to see who the principals were. And then I would say, if there was no one from Wharton, then I would say, oh, you went to Harvard, I went to Wharton. If they were from Wharton, I was like, we both went to Wharton. But the point is that in my case, I used Wharton, but you could say you went to my alma mater, or I see that you like football, and I do too. Your favorite team is whatever, because they usually give a little bit of personal history in their bios on their
And you
websites.
and you
So
do
just
that when you're calling them or you sending them
yes,
a letter.
when
Okay, so
you're reaching out to them, just
okay,
look
sure.
for some point of similarity, or use your LinkedIn contact and ask for an introduction. But look for some point of similarity, and it works. I mean, I respond to people if someone just says, "Hi, I saw you," blah 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 blah. No, but if they say, "Hey, I saw that you ran track, and I used to run track, and I'm interested in this, and I would love to talk to you," then yeah, because I think that's cool. And they found out a little bit about me. They took the time to find out a little bit about me. It's not just somebody who just wants something. They're
Right.
actually
Sure.
somebody that would be interesting to talk to. So
That's
to do that,
a good, best practices for a lot of things, right? It's
yes,
you're looking for a job, you're looking for money, you know what I mean? You
yes,
want to know who you're talking to. So,
yes,
okay, so one of the ideas that I think, let's kind of shift gears a little bit and kind of
okay,
roll into the equity side, but and I don't want to spend a lot of time talking about specifically on angel investing in VC because we cover that all the time, and we're starting to round the bend on this. But I
okay,
think one of the things that has become a really great way to bootstrap if you're inventing something or inventing a gadget or you have something is being the reward based crowdfunding. It's
mm-hmm.
challenging. It's not easy,
Right,
right? It's not any easier, but
yes,
it does give you the means
it
to
does.
create a prototype and a minimal viable product and and test the market for your product before you've spent a lot of money or
Yes,
gone and raised a bunch of capital or put other people's money at risk,
yes,
trying to see whether this, because the ideas that we have, and it's I'll talk to entrepreneurs and they'll have this idea and they'll talk to 5 people and 5 people will say, yeah, I think it's great. And it's like, well, they're of course they're going to tell you it's great. You need to go to a marketplace that doesn't know you and see if they really want the feature function benefits that you're intending to offer. And
right,
reward based is a really good way to test your marketing strategy, test your and get your prototypes and MVPs done, get some
yes,
inventory going, get a baseline of this. And then when you roll into those things like angel investors and VCs, you haven't given up equity. You've already proven a big chunk of it.
right,
Very similar, used to be back in the day if a company got an SBIR grant,
Mhm.
investors loved it because it got their
Right.
product developed and they didn't give up equity, and
Right.
it was a lower risk thing. And that's kind of the way, crowdfunding, I think, has been viewed as that. And it's a great bootstrapping way to get things going. And
It is.
nowadays with Reg CF, you can roll in from reward to something like that and not really give up a whole lot of equity. If you're in a non-traditional type of business that's not going to go the VC route, then you're in a position. Have you seen where people then become in a position that they could get traditional financing going forward if they if they did a bootstrap of figuring out, they raise $500,000 through Reg CF or intrastate, and then they're in a good position as a traditional business to get debt?
Yes, yes, because uh, the lowest cost of capital obviously is a bank, and that's why it's harder to get it because it's the interest rates are much lower. And so they like less risky things. And if you have generated, basically what you're doing through crowdfunding is pre-selling. You're pre-selling because the rewards you're giving are something. You might not actually be giving the product, but lots of times they're giving some kind of prototype of the product, or maybe they're giving, you know, t-shirts tied to they're giving something, but it may not be the product depending on what size it is. But for smaller products, it often is you're getting an early version of the product to use or whatever. And so, like Karen said, it's lots of like you said, lots of market testing and so on. But it's proof. Now you have actually income. You've generated income. You know how to market. That's a big thing. And lots of companies go and do crowdfunding, but many are not successful. The
Right, because
biggest thing is, the average inventor or someone who has a great idea is not a good marketer. So but part of any business is marketing, whether it's B2B. B2B might be more business development type things or whatever, not, social media kind of marketing, but you need it. So what I say is crowdfunding really makes you hone your marketing skills, or makes you find those strategic partners or other people that you'll need on your team who will really help you grow your business, because marketing is absolutely critical to a successful crowdfunding launch.
okay.
And
And
but yes, it does, because it gives you the money. If you have, here's the other thing. You could also, if you have a product and you don't need to do development, for those of you that are outside of tech or outside of, aren't trying to be a manufacturer or whatever, then you can do pre-sales. You can pre-sell your product. You can take, or if you have a service that you're developing, you can pre-sell your service, or you can take deposits on your service. These are all ways to generate funding up front before you actually incur the cost, because it's all about managing your cash. You want your cash to come in before you spend it. So inflow, cash coming in from revenues or wherever, or and then outflow, cash going out to pay everything and everybody and so on. So that's the point. So wherever you can get that from, that has the lowest adverse impact on your cash outflows, the better.
yeah. So let's shift over, because another where there's a lot of confusion is the private equity funds in the private equity, not angel and VC, right? So, sometimes private equity funds will come in a company that's after VC, but usually they're like parallel tracks. Private equity funds, some of them will operate kind of like a VC. So talk a little bit as we start to wrap up here on, the way that private equity funds, when they take controlling interest, when they don't, when it's growth capital, you know, when there's a earn out over time, they may have something where they have the owner on board for a while before they buy the rest of it. It's kind of a roll up a strategy. So there's all different kinds of private equity funds and industries, and they play different ways. And so when you're thinking strategically, because you're not necessarily a venture capital backed kind of a company, when should you start thinking about private equity funds as part of growth capital? And, you know, just along those lines, a little, you know, clarify that for folks.
Well, private equity is, I mean, there's been more participation of private equity firms with more recently, like in the last 5 to 7 years, but with you know, in the space that VCs play, there's been more. Again, nothing like the VCs, but more because of, you know, these large tech companies staying private for so long, and so it becomes more. So they have a, you know, so they have a history that private equity firms can look to. But private equity firms still generally focus on existing, more traditional businesses that they can leverage, that they can, you know, that they can use debt to be able to pull their money out, because they typically are looking, you know, venture capitalists may stay in for 7-10 years. I mean, it depends, but private equity firms are typically more short term, 3 to 5 years, and they want to get their money out. They may not completely sell the firm or take it public or whatever, but they tend to be shorter term. Not always, but they tend to be. So it depends. I mean, you have the, like when I was looking at private equity firms, it's funny, there were those that were looking to, so you have some companies that will do as little as 20% equity. I haven't seen any that have gone less than that.
Right. No.
But
no.
yeah, 20% to 100%. So there's some that want to do a full out acquisition. They want to acquire it. They want to hold it. They want to.
They're doing a roll up to be able to create a bigger company that then they can go take to market because they bought this industry division or this division that does that, and they're creating
roll up. People don't like roll ups. So many roll ups have failed that they don't like to use the term roll up anymore. It's more about, yeah, it's more about, if you have a vertical strategy, then you may add companies on to build the vertical strategy, or you may decide, I want to, you know, this is a very disaggregated industry, and so I want to build a stronger company by adding in these companies. So
because of industry consolidation.
So it's kind of like
the roll-up may be an old term, but they're consolidating a fragmented industry by, you know, bringing
it's a lot more strategic than a roll-up. It's just a lot more strategic than a roll-up. People would just throw the companies together. Who cared about the culture, the fit, and so on? And that's why it didn't work well. So they're looking for, you know, for complementary. They're looking for businesses that they can reposition operationally or provide a lot of resources to, including excellent management, and for some, and then be able to pull their money out at some point in time, either through sometimes they sell to another private equity firm. If they like larger companies, they may take it public. It just depends. Or they may do like I said, a recap where they just load it up with debt and pull all their money out, and then, you know, maybe sell to the management or whatever and exit. It just depends. But it really is about what's the strategy. And you have to, in all the private equity firms clearly state their strategy all the good ones clearly state their strategy on the website, and you can see what the portfolio companies are. If you want to exit your company, if you're an owner and you're ready to exit, then a private equity firm could be a potential buyer. If you want to grow, then you want someone who is maybe only, at the 20% mark, because you want to retain ownership of 80%. But in exchange for that infusion of capital and so on, you'll also get guidance and whatnot, and you will be less stressed, and you can grow a lot faster. Or you may need to buy out a partner. You own 60%, your partner owns 40%, whether it's your brother, your friend, or whatever. Then how are you? And so a private equity firm could buy out someone, and you'll see that sometimes. You'll see that a lot. Private equity firms will come in and buy out a partner. So they don't want to have, those firms don't want to, they want to have like a controlling interest or a sizable piece, but they don't necessarily want to be the majority owner, but they want to have significant say. So they'll do the 40 to 49%. That's where they typically play. So again, what is it that you need the money for? Well, not just what you need forget about what you need the money for. I mean, that's important, but it's what's your long-term strategic objective? Is it growth? Is it to retire? Is it to buy out a partner? That will decide which private equity firm you go for. And there are smaller private equity firms, but I will say this, private equity firms tend to raise capital. And so like I looked at ones, and then I would call them and find out that they no longer were looking at EBITDA of 2 to 3 million because they had raised so much money. They now were looking at EBITDA of 5 to 7 million.
Right.
So you just have to be aware of that. That happens a lot, because when they're successful, then other people want to buy in. And so when they go to raise more money, it goes to raise another fund, they're able to raise a lot more money. But there are smaller entities out there where there may be only 2 people in the fund, and they play in the I'd say $1 to $3 million EBITDA space, and they tend to be more of the minority interest private equity firms. They're out there. You just have to look.
Yeah. So a great place to go look for those firms is the Association for Corporate Growth. Now, under COVID, they're not doing their capital connections as much, but I'm sure they're coming up with some virtual aspect of that. And the thing that I loved about that is that there's hardly ever any entrepreneurs at these things, which is really stunning to me, because they have a reverse capital expo where all the private equity firms that are part of it in that region, could be 200 companies are there. You get a book ahead of time that says this is their baseline. It's 10 million revenue, 2 million in EBITDA. These are the industries. These are the companies that they've invested in. This is their portfolio. And you mark them. You go table 23, table 48, table like this, and you go and you talk to them, and you can find the sources of funds that fit the kind of growth strategies you have. And so like when we work with companies that are in that gap, I've been establishing relationships with these private equity funds because I want their rejects, right? They're too small for them. So I can put a capital strategy in place that says we're going to grow you to the size that you can be in play. There's a big chunk of, probably the majority of them will say their bottom floor is 10 million in revenue, 2 to 3 million in EBITDA. Now they'll flex a little bit here and there, but I would guess that a chunk of them are like that. And the biggest chunk of those that are like that will do about a 30% where it's a growth strategy. And, then they partner up with somebody else that comes in and might buy out the rest of the equity, or they do get it. They're helping you prepare to sell. So if you are in, as an entrepreneur listening, if you're one of these guys, maybe you got an angel round, you miss your VC round, you're sitting there with 3, 4, 5 million in revenue, and you just stuck, can't figure out where to go get the kind of money you need to bring another product out. Then what you want to do is, work with both of us. I'm going to tell you right now, is like, right? So Tiffany going to get the operations set up so that you can improve your cash flow. And particularly I've had these companies that the guy will wake up, he's been running his business for 10, 15 years. He's been doing his books for the tax man and not the bank. He's been siphoning out money, putting it in this company, that company. And he's like kind of moving these shells around. You know, like, guess where the actual money is underneath this turtle shell,
Right.
right? And so you
Right.
got to get yourself together, because you won't qualify for anything if your books are all like you don't make any money. And so it may take a while. This 12-week plan she's talking about, right? Then we put a capital strategy in place. We do a small bit of debt that might help you get the cash flow you need for lawyers, accountants, these other things, a marketing thing, an advertising plan, so that you can go raise money through a 506C or a Reg A plus. And then you set yourself up from going to $5 million company to a $10 or $15 million company. And then Tiffany and I will get you introduced to these private equity funds that will start to help you get an exit strategy. Because sometimes they'll come in and initially, and it's a really good strategy for second gen companies.
Mm-hmm.
The dad started it. Now the next gen is coming in, and they got all these great ideas for growing it, for going into a digital product or doing these other kinds of things, and they need the money to do it, and dad wants to retire. So you can build it up like we're talking about, and then have somebody that comes in and buys out 40% of the company for the dad, helps you build it to twice that size, buys the rest of it out. Dad and mom get another chunk of change, and you as the second gen get the rest of that exit strategy. And it can really work well when you understand how to layer in a debt strategy and an equity strategy, a short-term strategy, and a long-term strategy.
Yeah. And one thing I want to add is that just like VC money, private equity money has people behind it who are focused on how you're running your business. So they hold you accountable.
Mm-hmm.
So I think it's like, I don't know if any VCs are like, just go do whatever you were doing. And no, you can do, if what you were doing was working, it's still working fine, but we need updates. We need periodic meetings. We need to see financials and all of that. So I think I agree with you about the next gen, because lots of times the parent was really entrepreneurial and may have been very disciplined and so on, but the kids they do okay, but they need more accountability and so on. And if the parent truly just wants to fully retire, then having that private equity entity come in and provide the professional leadership and insights and so on can be very, very helpful. So yes, private equity is not silent money. Just be aware of that. It's not silent money. They definitely are going to participate. Some will participate more. And when I also like what you said, I know we're not doing anything, there's no in-person meetings, but like you said, the Association of Corporate Growth, if you can attend one of those, but I know it's intimidating, but there's a lot of fractional CFOs out there. Granted, most of them are more like controllers, but if you can find one who actually does do something with financing or raising capital, what you just want is someone who can go with you, who knows how to speak the lingo, because as an entrepreneur, it can be very intimidating to approach private equity firms and talk to them about your business. And you're thinking, oh my gosh, these guys have all this money and so on. And it can just be intimidating. So you can bring someone with you that will help you. But yeah, it's a very captive. And like Karen said, it's usually the lawyers, the CPAs, it's usually those bankers who go and talk to the private equity firms. It's not entrepreneurs.
Yeah, I know. I was stunned when I started going to these meetings. Okay, so everybody, if you're it's the resourceful
Yes.
Okay, to get more information. And there's the book. The book is The Funding is Out There. Access the cash you need to impact your business.
Yes.
There it is. See, money flying all over the place. And so Tiffany is a great resource. And, my website is KarenRands.co. You can see the sources of capital that we work through with Launch Funding Network. So as we wrap up here, any final thoughts you want to share with the audience, Tiffany?
Yes, I'd say go, if you go to the Resourceful CEO, you can download a case study where I did I
Excellent.
took a $10 million transportation firm that was basically their balance sheet had serious negative equity. And I completely transformed them, worked with them, but basically transformed them in a course of 5 months. And it just, I mean, it's like night and day, less than a year later. So I outlined what I did and how I did it. And so you can use that to as inspiration.
Very good. Very good. And as always, it's great to see you again, Tiffany.
Good
Sometimes I
to
think
see you too, Karen.
it's been a while. So thank you for reaching out to me. I'm glad you came on the show today.
Thank you.
And to all of our listeners, onwards and upwards, stay safe. Thank you very much for tuning in today.